Onfolio Holdings, Inc. It trades on the NASDAQ under the symbol ONFO and acquires controlling interests in and actively manage small online businesses that they believe operate in sectors with long-term growth opportunities. Happy to welcome its CEO, Dominic Wells. Welcome to the conference today, Dominic. Nice to meet you.
Yeah, likewise. Thanks for having me. Happy to be here. Looking forward to this.
Wonderful. Well, the floor is yours. Call me back when you're ready for questions.
All right, sounds good. Okay, I'm not sure how to actually get the slides up.
They're up already. You just advance through them with the next button.
Great. Okay. Okay. So yeah. Hey everybody. I'm the CEO, and I'm delighted to be here and introduce you to my company. Or if you're already familiar, then give you an update. So we are basically the online business holding company. We acquire and scale profitable online businesses. What that really means is we specialize in identifying under-optimized businesses. So they may already be profitable, but we see they've got opportunity to grow organically, maybe have some tuck-in acquisitions and grow inorganically, and unlock more value through just strategic growth and the improvements that we know how to make. Since our IPO, we have added about 8-9 million in revenue through 7 acquisitions. So that brings us to around maybe about a $12 million run rate is where we are at right now. We have a lean management team, both at the corporate level and at the portfolio level. We believe it kind of makes more sense to not overbloat these companies with management because they're pretty small companies. And collectively, we have a lot of experience operating businesses. We have a lot of experience acquiring online businesses. We own a good chunk of the company. We've got skin in the game. We all have growth mindset, and we're really driven by what is the value we're getting out of these acquisitions? What is the data saying? What is the ROI? And our compensation structure is designed to align that as well. So at a higher level, we are basically just trying to become one of the world's best serial acquirers, and our speciality is online businesses. And I know an online business, that's quite a broad term. So, what exactly do we mean by that? I will go into more examples later in the presentation, but essentially what we're focusing on is more about building this repeatable, scalable system that allows us to find good acquisition targets and then acquire them and integrate them and grow them. But really the bigger picture is we're growing through acquisitions. So maybe the companies we acquire, they're good businesses, they're strong. But if we only get, say, 10% growth out of one of those businesses, that's fine, because we're going to grow significantly through the actual acquisitions we're making, which you can see in our revenue history to date. And yeah, one of the reasons we went public was so that we can use those public market advantages in our favor. So lower cost of capital. We're not in the world's lowest cost of capital period at the moment in the public markets, but it is generally favorable for public companies versus private. I put stock as currency here, but that's mostly because we've been using our preferred stock for acquisitions. There's a higher level of trust and credibility, which is very important when you're buying these small online businesses from maybe individual founders, small teams of founders who maybe are not as sophisticated. They've probably never done an acquisition before or been acquired before. So when they're dealing with a NASDAQ listed company, they're much more likely to sell to you at a more favorable price simply because you're a public company. So we typically buy these businesses, and you might see in our slide deck, sometimes we call them digital companies, sometimes online, sometimes internet. There's lots of different labels. We try to use them interchangeably just to help everybody really wrap their heads around what it is we do. We typically pay 4 times EBITDA for for these businesses, which is obviously well below the public markets. So there is a little bit of arbitrage there. Now, our acquisitions are primarily financed through cash flow, through strategic debt, with little to no dilution. And we integrate our playbooks, as I mentioned. So those playbooks could be efficiencies, strategies. Of course, we're looking into AI and how we can then add AI into any acquired business to improve its margins, improve its the speed and its efficiency, or just add additional offerings that they weren't able to do previously. And we've really had clear progress to overall corporate profitability over the last, I'd say, 6 to 12 months. So we acquire profitable businesses, but historically we haven't been profitable because we're small. We have those corporate overheads, the public company overheads. But over time, as you'll see on a later slide, we've really closed that gap and we've reached a pretty good position right now. So if you're looking for a kind of catalyst, I think the timing is pretty good for us right now. So when we're acquiring companies, what is our competitive edge? Like what can we do with an acquired company that others can't do? And why would the owner of one of those companies prefer to sell to us rather than a different acquirer? And it's really 4 things that we've identified so far. The first is growth strategy. We inject growth into these acquired companies either via capital, via human resources, synergy. So as I mentioned, we've had 7 acquisitions since our IPO. And each time we acquire a business, we not only get better at operating businesses and helping our acquired companies just building a playbook for those acquired companies, because we learn something new every time, but we are also unlocking more opportunities for cross promotion or for synergies and all of those things, because we're essentially increasing our surface area. So that kind of goes into the next point, which is these scalable operational playbooks. So when you buy, I guess, any business, but the kind of businesses that we are playing with, there's probably a list of things that you need to do to grow them. And you don't always know which thing it's going to be before you acquire it. You can have an idea, but until you're actually in the driving seat doing those things, you don't really know. And what we've done over the last sort of 3 years since we went public, or 6 years since inception, is we've built that list. And so maybe when we first started acquiring businesses, there was like 3 things that we could do to grow it. Now, maybe there's 20 things, and we never know which 3 or 4 things from that list of 20 it's going to be, but it's always something on that list. And if it's not, well, now we have 21 things on the list. And so that's really how we can come in and add a lot of value to the acquired companies. We're also long-term holders. We're patient capital. We're not looking to buy a business, double it in a short term and then flip it. Not necessarily anything wrong with that business model. It's just that's not where we specialize. And we try to make these businesses as efficient as possible, which might mean, cleaning up the organization a little bit, letting people go, or it might mean bringing in better people, things like that. Now, for investors, for shareholders, whether you're a shareholder or considering becoming one, the competitive edge that we have is capital structuring. So we understand, okay, we're looking at making this acquisition. When should we pay a little bit more? When should we pay a little bit less? When should we use an earn-out? When should we pay less cash up front? When should we pay more cash up front? All of these things, we're pretty good at it, but I think we also get better over time. And so we also have compounding growth. And as I mentioned, it is largely through acquisitions. It's not necessarily through organic growth, but that's always going to be the case, even if we're getting 100% organic growth with a portfolio company. We then buy another business that has 10 times the revenue. It's, as a percentage, it's always going to be acquisition driven. We've got that private to public market leverage arbitrage I was talking about earlier. If we're buying businesses at 4x EBITDA, 5x EBITDA, and at some point we should be trading a lot higher than that ourselves, there's that nice arbitrage. And then I kind of put relentless efficiency twice. I put it on the previous slide. I'll just go back to it quickly. Number 4, and then this slide, number 4. It's there because whether we're dealing with the kind of corporate level, the holding company level, the parent co, or we're dealing with one of our acquired subsidiaries, we really are trying to be as efficient as we can be, both in terms of spend and kind of speed of execution. Okay, so what is our acquisition criteria? What kind of business sizes are we buying? What do they look like, and so on and so on. So typically, we look for a business that's about 500K to about 5 million EBITDA. We'll go lower if it makes sense. Like, let's say it's a tuck into an existing acquisition. Actually, kind of working on one right now which fits that bill. And we're not married to 5 million being the ceiling. We'll go higher if it makes sense. We just haven't gone higher. I think we may find it harder to get good returns if we go higher, or it's just, you kind of have to level yourself up as you go. So that means the transaction size is around 1 million to 20 million. Our largest to date has been about 5 million. So 20 maybe is a stretch, but that's kind of the size we're playing in. At the moment, we're quite big on e-learning, AI, not necessarily buying an AI business, but anything kind of AI related, we'll be looking at either as something we can implement to our business, or maybe something we can actually start and offer, like incubate a business. B2B marketing agencies, B2B and B2C info products. We do have some e-commerce. We're not huge into e-commerce at the moment. There's a lot of headwinds against e-commerce as well, so that makes sense. But we have a pretty varied portfolio. We really try to focus on a balance of optionality. So if we wanted to move into a certain space, we could, or if one of our businesses wanted to move into a certain space, it could. But at the same time, you need resilience, and we get that through diversification. So it's kind of like we want to have a diverse portfolio, A, to mitigate the downside, and B, to increase and enhance the upside. So as I mentioned, these businesses are always digital product or service-based businesses, a couple of physical product businesses, but we're not buying like brick and mortar restaurants or things like that. They need to have a proven track record of profitability. The longer the track record, the better. So for example, 1 year, probably too short. 5 years is fine, 3 years is fine. It also depends on what the tail is, whether it's been consistent over that period, or whether it's up and down, or whether it's trending down, and so on. We want it to have growth potential, but we also want it to have strong brand equity and customer retention. A couple of our recent acquisitions, Revenue Zen is a B2B service agency. They do content marketing and SEO services, and actually they're about to launch some AI content services and AI optimization services. Proofread Anywhere is one of the leading e-learning businesses out there for basically learning how to become a professional proofreader. A lot of people kind of look at that and think, well, that's not a sexy business, and they're right. It's not a sexy business, but it makes a lot of money, makes a lot of profit. So we're quite happy to own it. Eastern Standard is a digital marketing and branding agency. They work with a lot of like hospitals, universities, places like Cornell Law or Temple University, Temple Health. And then we have Content Elect, which is also a content marketing agency and software. So this is not our entire portfolio. It's kind of just the most recent acquisitions, and they're all quite representative of what we're interested in right now and where we're going. Okay, so our revenue weighting in 2024, we did about 7.8 million revenue, and it's basically 4.5 of that is digital services, close to 3 million is info products, and then the rest is the e-commerce businesses that we have. So basically, the flywheel we're going for here is we acquire a profitable business. We then cash flow that business, but also try to grow it. So we will reinvest some of that into growth. But then we take that cash flow and buy more businesses and rinse and repeat. And of course, we can also access other capital to accelerate it and make more businesses. Little bit about our history. It's been tricky. We went public in 2022, which was not a great time to go public, and we're a small company and so on, and we were unprofitable. And so 2022 till probably about 12 months ago were pretty rough, both in terms of our execution. I thought we did great things, but we also could have done a lot better. And we just didn't know what we didn't know. We were struggling to get access to capital for more acquisitions. We probably overhired at the central level. I think we probably did all the classic, like, newly crowned public company beginners did, and we've done a lot better over the last 12 months. So our organic growth of the acquired companies is kind of back. It's just back. Like, they weren't growing before. We've gone from a kind of fully centralized to decentralized to more of a hybrid. Basically, now we just do what it takes. We're not married to should we be centralized or decentralized. We just say, well, what do these businesses need? And so we basically reached the point now where some months we're profitable, some months we lose a bit of money. So I guess people call that break even. But we're in good shape, and I'm feeling pretty positive about the future. I will talk about AI a bit. I know it's flavor of the month, and to the point where it kind of becomes a little bit like hyperbole, and it almost sounds hypey. But basically, what AI is for us, sometimes people say, is it a threat? Is it an opportunity? And well, it's kind of all of the above. But where it's really benefiting us is it's enhancing the profitability of our companies, either because some things that were done manually can be automated by AI. And I think actually that's where everyone really expected things to go. And in reality, they probably haven't gone that way as much as anyone expected. Maybe they will. But really where it enhances profitability is kind of like our ability to either do the same things faster or do more things. So for example, Proofread Anywhere, it'll have some very profitable Meta ads or Google ads, and eventually those ads aren't profitable anymore. So before AI, we would be like, okay, let's create some new ads. Maybe that takes a week. You come up with 10 new ad creatives and you test them, and you find one that works, and then your revenue is back in good shape. Whereas now you can build a kind of creative production line where you're producing 30 or 40 potential winning ad creatives, and you can do it very fast. You can test it before you need to test it. And then if you imagine us just being able to do lots of things like that across the portfolio, and us being able to buy a business that isn't doing any of those things, because when someone's selling a business, they're not going to bother learning and implementing all those new strategies. That's kind of where AI helps us. The other way is we're actually launching some AI services, which you'll probably see press releases about over the coming days or maybe weeks, where we're basically helping other companies do the same thing that we're doing with AI, is the high level there. So our financials are just, I kind of want to save time for questions. So I'm going to kind of breeze through them. And of course, you can see them on the SEC website anyway. But 2024 versus 2023, revenue was up mostly through down to acquisitions. Cost of revenue went up accordingly. Total operating expenses down significantly, and then net loss down significantly as well. And then we have a kind of adjusted EBITDA slide. And then I think this is a really interesting one. So historically, our corporate expenses, which is basically the pubco costs like NASDAQ fees, audit fees, investor relations, all of those things, and then the kind of C-suite admin, legal fees and everything, those have come down significantly over time as we've got more efficient, and just things get cheaper, like our insurance is cheaper and things like that. But the EBITDA being thrown off by our portfolio is going up significantly, and we're at that point where they're going to cross over. So I think this is my favorite slide. Let's just put it that way. So we've had kind of strong progress towards consistent profitability, and that's because, as I mentioned, corporate overhead has gone down and portfolio profit has come up. Those things are on track to continue. In fact, I'm not even sure we need them to continue at this point, but yeah, very, very good shape. Deal financing's got a little bit easier as well. We kind of had to get really creative to actually be able to buy more businesses over the last couple of years, whereas now we've unlocked kind of the more traditional debt. That's really a function of us being more profitable and us having larger revenue and more of a track record. Like, go figure. It gives you access to better better capital. So really, if I could leave you with something, why would you invest in Onfolio? Because we're committed to becoming, one of the best companies out there for acquiring and growing digital businesses. And there's so many businesses we can buy. There's not really any ceiling on how high we can go. It's just a function of us taking the steps, making mistakes, unfortunately, learning as we go, getting better and getting better and getting better, and getting larger through just getting reps in. We've got a proven model for digital business growth. We've got strong growth at the corporate level from acquisitions. We've got a clear trajectory to consistent profitability and good returns. And we do have some AI-enabled scalability, and we've got experienced leadership with a good track record. So investors at onfolio.com. If you have any questions, you can find us at onfolio.com. You can always reach out to me. And I'm going to go back to Anna now to go through with some questions.
Thanks, Dominic.
Thank you.
Okay, let's jump in, see how many we can get through. Alex wants to know, what percentages of the businesses are you buying? Are you acquiring 100% of them, or does previous management retain some skin in the game?
It kind of depends. So I think the smallest percentage we've ever bought is about 52%. But even when we bought that, we brought in some joint venture investors who invested alongside us. So we still controlled, I think, 90% of that acquisition. Management retained 10% in that case. Sometimes we buy 100%. It's the most important thing to us isn't always that management retains skin in the game, and there's other ways of them getting skin in the game. Because the other thing is, if you buy 75% of a business, then that's 25% of its profits are always going to be going to somebody else. So there are benefits to having a much larger chunk and keeping more cash in the company to reinvest elsewhere. So it's kind of about finding the sweet spot between what management wants, what we want, and what is going to sufficiently incentivize them, but still allow us to capture as much of the value as possible.
Rose asks, what do you look for in a target? Is it industry, revenue? What metrics do you look for?
It's usually, it's kind of everything, but the first thing we look at is how profitable is it? And it's not just like P&L profit, but cash flow. And the other thing is, how do we feel about that? Is it trending up? Is it trending down? Do we think it's going to, what do we think that number is going to do in the future? Or how can we influence that? Industry is important as well, because we have to know that we understand the industry even better if we have experience with it. So at the moment, because we've got a lot of B2B services, so say email marketing, branding, content creation, something like that is going to be a lot more appealing to us, just because we understand it and we know how much we can influence it. Does it have a strategic value where we know we can plug it into our existing portfolio, either to fill a gap in our portfolio's needs, or to cross promote to share clients or something. So yeah, it's kind of everything.
Okay, thank you for that. Alex wants to know what type of safeguards are in place for undisclosed agreements that might come back to bite you.
Um, I guess my follow-up question would be, do you mean undisclosed agreements that they already had in place before we acquired the business?
Yeah, with the companies that might have the undisclosed agreements that you acquire.
Yeah. Well, I mean, first of all, you've got to do good due diligence, but for things that maybe you didn't even know about, there's a lot of things like reps and warranties and clawback clauses in the acquisition agreements. So if you later found out there was some fraud or someone was getting
Mhm.
kickbacks or something like that, then you have the ability to go after the seller of the business.
And Jim wants to know what accounting practices do your targets practice for the most part? And what's the rule for converting them to GAAP accounting? Is it required?
Yeah, it's required, and it's one of the it's one of the most challenging things I think in the acquisition. So obviously we have to look at the operations of the business. We have to um, we have to look at the finances. But a big thing is, ideally, before we even finish acquiring it, we might rebuild their books. The, to answer the question, most of them use cash accounting. The better ones use accrual, but even when they're using accrual, it's usually not GAAP. And so, but the rule is, yeah, we have to, if we want to consolidate the finances into into ours, which we do, then we have to switch them over to GAAP.
Raphael asks, what does your exit look like? Is it a go public transaction?
Um, for the actual acquired companies, I guess. Long term, we want to hold the businesses forever, and because we're already public, we kind of get that benefit anyway. But nothing's ever off the table. So if it makes sense that one of our acquired companies would make it would make sense to spin it out, either maybe it would get a higher multiple than we will, or it'll grow faster as a standalone entity, something like that, then yeah, we'll do that. I think it's also, do we feel like we want to hold this business long term anymore? Maybe it makes sense to sell. So it's really, I think our default assumption is we'll hold it forever, but there are definitely situations where it makes sense to sell it.
Viewer Michael says he loves the overall acquisition as well as capital raising strategies you've been implementing these past 2 years. He's got a few questions that are a bit in the weeds. He wants you to clarify why the Q1 2024 versus Q1 2025 press release reference is different. Q1 2024 revenue is 1.59 million versus 1.58 million. Operating expense 1.61 million versus 1.45, and net loss amounts 0.63 versus 0.47. Can you address that?
Yeah, so the most recent Q is the accurate version. Basically, we redid our 2023 financials. We re-audited 2023, which meant some of the 2023 impairments changed, some of the deferred revenue changed. So basically, the real numbers for Q1 2024 changed. So now when we're doing the press release, the earnings release, like 2 weeks ago, then we used the most recent numbers rather than like the previous ones.
Okay. And for the quarterly period ending 9/30/24 in the 10Q, there's a mention of material weakness in internal controls over financial reporting per item 4 controls and procedures section. So can you elaborate on that?
Yeah, and I think we've had that. I think we've had that since inception. So it's not. I don't. It's not just in that the Q3 last year one, but basically, it's pretty common with small companies like us. Basically, a lot of the deficiencies are because we rely on third-party experts to help us. So we have all of our internal controls. We have. Um, we have everything that you would expect, but because we work with small advisors and outside firms who offer this service to a lot of NASDAQ companies, the auditor basically has to say, yeah, you guys have a material weakness because you're not doing all of this in-house. Yeah, it's basically that. So has to get disclosed and everything.
Perfect. Well, thank you for
There was a
answering.
follow-up question, sorry, about what are we doing to address it? So basically just, as we get bigger and better and more profitable, we're bringing more of it in-house. And
Sure.
if the auditors make recommendations, then we do that.
Perfect. Well, Dominic, thank you so much for answering these questions and for this thorough presentation. We really appreciate it and enjoyed it, and hope to see you back on the conference real soon.
Yeah, thank you. Thanks for all the great questions, everyone, as well.
All right. We'll be right back, everyone.